This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This lecture is on basic variance analysis. I hope you've got the free lecture notes in front of you. Before I go through this though, and it will be quite a long lecture, although I will break it, there'll be several shorter lectures, can I make it very clear that what we're doing in this lecture is pure revision of paper F2, because what we call basic variances are examined in full in paper F2. Now in paper F5, although there used to be a time when they did have full basic variance questions, these days the examiners said there won't be any questions entirely just on basic variances. You know, the next chapter, which the separate lectures on, has more advanced variances, and they are what are examined in paper F5. The problem is that although you won't get a full question on paper F2 variances, certainly there can be little bits of paper F2 variances. There's a small bit of a much longer question, a bit of basic variances, but then the bulk of the question being the more advanced ones. And also the more advanced ones, which are in the next chapter, although to an extent it's learning rules, it's really doesn't make sense learning them on their own unless you are already happy with basic variances. It extends what we do in this chapter. So one way or another, this chapter is important. If you remember your paper F2 variances perfectly, then by all means skip the lecture. I mean, to make sure, I would have a go at the example 1, and check you can remember them. But if you're at all unsure, if you were never happy at F2, or you've forgotten F2, or you were exempt F2, then I think it is worthwhile going through for the reasons I've been saying. So let's make a start. Can you go straight to example 1, which I think is on the 3rd page of the chapter, and have a quick look with me. It says a company has prepared the following standard cost card. So standard costs, materials 18 a unit, labour 25 units, and so on. So a total cost of 68 a unit, with budgeting on a selling price of 75 a unit, and you've got there the budgeted production and the budgeted sales. Below we've got the actual results for the period. So we actually sold 8,400 units for 613,200. We actually produced 8,900 units, and you've got those costs below. And the first thing we're asked is to prepare a flexed budget, and that can be asked in the exam, certainly. Preparing a flexed budget has been asked several times. And to calculate the total variances. Now, assuming you've watched the earlier budgeting lecture, where there was a very simple flexed budget, you'll know what it is we're talking about. But, well, let's do it here. And before I do, just one thing. If you look at the cost card, you'll see that in the costing, they've included fixed overheads at 15. It means it's absorption costing. With absorption costing, we absorb the fixed overheads into the total cost. Again, here it's 15 a unit. With marginal costing, and I'll talk about what effect it has on all this if it's marginal costing, but with marginal costing, we don't bring in the fixed overheads into the cost card. That 15 wouldn't be there. Now, I'll talk about what would happen if it was marginal costing later. For the moment, this is absorption. And so just like we did on my baby example in the budgeting chapter, sorry, I'm wondering where to stick it. I'll do a table. I'll first of all write up the original fixed budget. And then, I'll remind you what it is when we come to it, the flexed budget. And just so I don't get lost, remember in the original budget, the fixed budget, in units, we were budgeting on production of 8,700. We were budgeting on sales of 8,000. And so surely, it says there was no opening inventory, so if we produced 8,700 and only sold 8,000, there will be closing inventory of 700 units. Anyway, that's just so I don't get lost. Let's actually write up the budget profit statement. First of all, the sales revenue. Now, I'm not going to write all the workings down. I really shouldn't need to. But we're budgeting on selling 8,000 units. The standard selling price is 75 a unit. And so we're budgeting on revenue of 600,000. The cost of production. Well, remember, we're producing 8,700 units. And so the materials, from the cost card, it should be 18 a unit. So 8,700 at 18, 156,600. Labour, 25 a unit, 8,700 at 25 is 217,500. Variable overheads, $10 a unit, so 8,700 units is 87,000. And finally, fixed overheads, 15 a unit, so 8,700 at 15 is 130,500. So the total cost of production budgeted 156,600, 217,500, 87,000, 130,500 is 591,600. And incidentally, obviously in exams only do what's required. I could have written that total down directly because we produced 8,700 units. The full cost per unit from the cost card is 68. And so, well, it serves as a check here, 8,700 at 68, yeah, 591,600. However, that's the cost of the 8,700 I've produced. To get the cost of sales, we need to subtract the closing inventory. We said earlier, if we reduce 8,700 and only sell 8,000, there's 700 units left. And the cost per unit, the standard cost, 68. $47,600, which gives the cost of sales of 544,000. So finally, the original budget profit, revenue of 600, cost of sales 544. The budget profit is 56,000. Now again, as I've said, obviously in exams, only do what's required. If they required a full budget profit statement, there it is. If all we needed was to know what the budget profit is, again, I could have written it straight down. Because we had sales of 8,000 units. The standard profit per unit, selling price 75, cost 68. So a profit per unit of $7, 8,000 at $7 is 56,000. So there's our original budget. And again, revising what I said in the budgeting chapter, one purpose of preparing budgets, one use of them is to use them for control. So that as we start working through the year, we can compare what, for instance, what we actually spent on materials with what we should have spent. However, if you remember, there'd be no point in comparing the actual expenditure with the original budget, because we were budgeting on producing 8,700, it turns out we actually produced 8,900. And so obviously if you produce more, you would expect the cost to be higher anyway. So to make it a fair, a sensible comparison, we flex the budget. We rewrite the budget based on the actual activity. The actual production was 8,900. The actual sales were 8,400. So let's now rewrite the budget. What should the revenue be? What should the production be? Again, that's standard revenue, standard costs. So it won't take me a moment. The revenue, 8,400 sold. It should have been at 75 a unit. So the revenue, you would now be expecting 630. The costs, well, materials, again, 8,900 from the cost card, should be 18 a unit. So we now expect to have spent 160,200. Labour, 8,900 at 25 a unit, 222,500. Variable overheads, 8,900 at $10 is 89,000. Fixed overheads. Now listen to me carefully here. I'll say part now and then part in a few seconds. By definition, fixed overheads should stay fixed, whether you produce more or whether you produce less. However, here we're using absorption costing. And for reasons I'll explain in a few minutes, if you'll be patient with me, if we're using absorption costing, we continue to charge each unit at the cost from the cost card at $15 a unit. Now, you're going to have to be patient with me. I know some people get very upset about this, but I'll explain why we do it in a minute. But arithmetically, we produced 8,900 units. If we charge at that $15 a unit, it comes to 133,500. So, whether you're happy or unhappy, make sure you're happy about the actual calculation. I keep saying I'll come back in a few minutes to explain why I've done that. However, if we carry on for the moment, that gives total cost of production 160,200 plus 222,500 plus 89,000, 133,500. I think 605,200, but again I can check that quickly because it's 8,900 produced. Each unit should cost 68 in total. Yes, 605,200. That's the cost of the 8,900 produced. To get the cost of the 8,400 sold, we need to subtract again the closing inventory. But here, if we produce 8,900 and sell 8,400, the closing inventory is 500 units and at standard cost of 68, 34,000. That gives the cost of sales of 571,200, and therefore the flexed profit 630 revenue, 571,200 costs is 58,800. All right, now let me say slightly more to justify perhaps why I did what I did with fixed overheads. Assume you're the managing director. You're not a management accountant. You're the managing director or chief executive officer. I gave you a budget, the original budget, and you were expecting, if you look at the cost card and everything, you were expecting we'd make $7 a unit profit. That's what I told you. I said the cost was going to be 68, the selling price 75. You're going to make $7 a unit profit. And so the original budget, I told you I think we'll sell 8,000. That's 56,000. What actually happens? Well, the first thing you notice, surely the first thing anybody would notice, is that you sold more units. Oh, we actually sold 8,400. What profit are you going to expect? Well, you told me $7 a unit. And so I immediately expect 8,400 sold, $7 a unit. I expect 58,800. Now, of course, I know it's not going to be 58,800. Partly because, we'll look in a second, but the actual costs were different than they should have been, which may result in more than 58,800, it may result in less than 58,800. I also know, though, that there's something funny happening with fixed costs. You know, $7 a unit assumed that fixed costs were 15 a unit, whereas in fact, fixed costs should stay fixed. And so fixed costs aren't going to be 133,500 at all. They shouldn't be. And so even if everything else is perfect, the profit isn't going to be 58,800. Well, fine, we'll need to explain that later, and we will explain it later. But with absorption costing, certainly initially, you bring in fixed overheads at the absorption rate of here 15 a unit. I will, for management purposes, as you'll see later, we will explain that fixed overhead problem. It's one of the reasons why the actual profit won't be 58,800. However, forgetting that for the moment, what was the purpose of flexing the budget? It was because now we can fairly compare the actual results and see where we've managed to save money or where we've overspent. Because the actual production, of course, was 8,900, the actual sales were 8,400. Revenue, we know we should have now had 630. We actually had 613,200. The costs, the cost of materials, the bottom table, actual cost 163,455, labour 224,515, variable 87,348, fixed 134,074. And so the actual total cost of production is 609,392. I hope I've got my arithmetic right. But again, that's the cost of producing, how many was it? 8,900. To get the cost of the 8,400 that was sold, we need to subtract the closing inventory. And quite importantly, with variance analysis, we value the closing inventory at standard cost. I'll explain why in a second, but the standard cost, remember, was 68 a unit, so the inventory will be valued at 34,000, which gives the cost of sales 609,392 minus 34,000 is 575,392, which finally gives an actual profit, if you subtract from the revenue, of 613,200. The actual profit, 37,808. Now, if we go back to inventory, remember we're not doing financial accounts. Financial accounts, you value in the inventory at the actual cost. With management accounts, we can do what we like, but the point is that this variance analysis we're going to do, usually we'll be doing this exercise every month. And of course, some months we might spend more than we're supposed to, other months we might spend less than we're supposed to. You know, some months the actual cost per unit may be more than 68, some months less than 68. Well, it's going to be a bit ridiculous normally if we change the value of the inventory month by month. Some months a bit more, some months a bit less. And so although we are allowed to change it, standardly, and certainly in paper F5, we keep the same standard costs throughout the year. It'll be 68 a unit. Now, of course, we can look at the variances, compare actual with flexed budget, and find out where we gained and where we lost. So the differences of the variances, variance means difference. First of all, the revenue. We should have got 630, we only got 613. We were down by 16,800. And of course, on its own, less revenue will result in less profit. Well, rather than put brackets and things in, if you remember, we write against it. For this one, A for adverse, because less revenue means less profit. If it's going to result in less profit, it's adverse. If it's going to result in more profit, we use the letter F for favourable. Looking at the costs, materials, we spent 163,455. For our level of activity, we should have spent 160,200. So we overspent. Overspent means less profit. It's adverse. Labour again we overspent. I can do it on my head. The difference 2015. Mean less profit, overspent. Variable overheads. We saved a bit, 89,000 minus 87,348. The difference is 1652, but since we spent less than we were expecting, spending less would result in more profit. It's favourable. And finally, the fixed overheads, without going back through that problem, but just a straight comparison. It's 134,074 against a flexed 133,500, an overspend of 574. And of course, the total of those variances should explain the difference between the actual results and the flex profit. So let's do it as a check. The variance is 16,800 adverse plus 3,255 adverse, 2,015 adverse, less 1652 favourable plus 574 adverse. I think they total 29,992 adverse. And does that explain the difference? The flex profit 58,800, the actual profit 37,808. Yes, that's made the difference. And although I'm not going to do it here, I will do it in a later lecture when we've done a bit more. We could prepare a statement for management explaining why the actual profit was different from the original budget. Because that's what management care about. What they care about is not so much the absolute figure. Is it 30,000? Is it 50,000? What they care about, they were expecting 56,000. And they want to know why the actual profit was different. And we can now tell them. The most obvious reason it was different was because we sold more units. We sold an extra 400 units. And at $7 a unit, that meant we now expected 58.8. So why didn't we get 58.8? We obviously charged a much lower price. That lost us an awful lot of money. In addition, we overspent on materials, labour, fixed overheads. All right, we saved a bit on variable. But we could, and we will later, produce a statement explaining why actual profit is different from the original budget. However, although I hope that was easy enough and it was just a slightly more involved example of the flex budget I did earlier, and you could be asked to do a flexed budget, so we've not completely wasted time. we need to do a lot more work on these variances, because look at that one, for instance. Clearly, we overspent on materials. There's no question. But if you look at the original cost card, the materials were supposed to be 18 a unit, and we've obviously paid more. But the reason this should have been 18 a unit is because we were expecting each unit to use 4 kilos, and we were expecting to pay £4.50 a kilo for the material. Well, why did we spend more than 18? It could have been simply that we paid more than £4.50 a kilo. Or it could have been that we used more than 4 kilos a unit. We were wasting some. Or, of course, a combination of the two. And we need to find out. We need to analyse that 3255. Is that due to the fact we paid too much per kilo? Is it due to the fact that we used too many kilos? Because there's likely to be different managers responsible. One manager is responsible for buying materials, and I want to know if he paid the right price or not. Another manager, perhaps the production manager, is responsible for using the materials, and I want to know if he used the right quantities or not. And so the real work in paper F2, basic variances, we need to go through each of those and analyse, find out why did we overspend on materials, why did we overspend on labour, and so on. So that's where the real work is. I'll stop this lecture here, but the next lecture will immediately go into those variances and start doing the standard analysis, the rules, which ultimately you need to learn.